You have probably heard someone say, just invest in index funds like it was obvious, and you nodded along, even though you had no idea what separated an index fund from a mutual fund, from an ETF, from a hedge fund. Most people giving that advice also cannot explain the difference. They just heard it somewhere and it sounded smart. A fund is just a pool of money where people throw in their cash and someone uses it to buy investments. The differences come down to who manages it and who is even allowed near it. Mutual funds came first. Before they existed, building a diversified portfolio meant buying dozens of stocks yourself, which meant only wealthy people could spread their risk. A mutual fund let regular people chip in, hire a professional manager, and that manager would decide what to buy and sell on everyone's behalf. You get diversification and the warm feeling that someone with an MBA is watching your money. The catch is most of them, after fees, do not beat the market consistently. They just charge you like they do. That is the entire origin story of the index fund. John Bogle noticed that most actively managed funds were underperforming the market after fees, meaning you were paying more to get less. His solution was to stop trying to beat the market and just copy it. An index fund doesn't hire a genius. It buys everything in an index, like the S&P 500, the 500 largest American companies. When it goes up, you go up. When it goes down, you go down too. But so does the genius manager who charged you 2% a year and still lost to a list. Index fund fees are almost comically low. Some charge $3 a year per 10,000 invested. The mutual fund manager charging $150 for that same amount has strong opinions about earnings calls. Whether those are worth the extra money is between you and your brokerage account. The ETF sounds different, but is mostly a structural variation. ETF stands for Exchange Traded Fund. A regular fund is priced once per day after the market closes. An ETF trades throughout the day like a stock, so you can buy or sell anytime during market hours. Most ETFs track an index, so index fund and ETF get used interchangeably. Technically imprecise, but close enough that nobody should correct you at a party. The hedge fund is where this story takes a sharp turn. Everything so far is accessible to any adult with a brokerage account. A hedge fund is deliberately not that. To get in, you need a net worth over $1 million or income over $200,000 a year. The government requires this because the strategies are risky enough that they should only be available to people who can absorb losing the money. The polite version of not for everyone. The fee is 2 and 20, 2% per year plus 20% of profits. They keep a fifth of your gains whether they earn it or not. The average hedge fund has underperformed a basic index fund after fees. Managers have many explanations for this. The explanations are free. The FEs are not. Mutual fund means paying someone to decide, costs more, historically doesn't beat the alternative. Index fund means no decisions, buying the whole index, cheap and hard to beat. ETF is that same fund, but tradable like a stock. Hedge fund is exclusive, expensive, and regularly loses to the boring option. The